Good morning. Thank you for joining our webinar today. We will begin in just a minute now.
Okay, there we are. Good morning. There's still a couple people to join, but we want to be appreciative of your time. And so we're going to get started on this beautiful sunny day here in Oshawa. Not sure what the weather's like anywhere else, but it's wonderful here. So, Christian, let's get started. You can get us going.
Okay, just some quick housekeeping items. Your camera and microphones are currently off. Please remain on mute and with your video off throughout the session. If you do have any questions, there's a chat feature at the bottom of your screen, and you can send us a message directly, and we'll answer them in the Q&A session at the end. Other participants cannot see your questions. They are only going to Derek and myself. So they are anonymous, or sorry, they are not anonymous, but they are private. All right. So title of today's webinar is Investing 201, How to Build a Successful Investment Strategy. Before we get going, a quick housekeeping note from our compliance legal department. So the material in this presentation is for educational purpose only and is subject to change without notice. Every effort has been made to compile this material from reliable sources. However, no warranty can be made as to its accuracy or completeness. Before acting on any of the information, please make sure to see a professional advisor for individual financial advice based on your personal circumstances. Any return information provided is for illustrative purposes only. Actual results may vary from your investment, savings, loan, or other investments available to you. Interest rates are hypothetical and are not meant to represent any specific investment. Rates of return will vary over time, particularly for long-term investments. Once again, please consult your financial advisor, in this case us, to discuss your situation before any financial decisions. That's just our standard housekeeping from our legal department. We just want to make sure that that is now taken care of. So, before we get started, just a quick recap of the Investing 101, our last webinar that we had, just for those who missed it, or maybe for those who are there and just want a quick refresh. In our last webinar, we went over the basic investment types. So these are equities or stocks, which are our growth-oriented investments. These are the ones we're expecting to grow more over the long term. We have fixed income investments, which are such as bonds and GICs. These are our defensive investments. So we're expecting a little bit of interest income, but relatively stable, not a whole lot of changes in value. There's also alternatives, which can serve many different purposes depending on what they are. And then ETFs and mutual funds, which are packages of different investments, which their goals, once again, can vary depending on how they're set up. The different investment accounts. So we covered RSPs, which are our tax-deferred investment accounts. So you get a tax deduction when you make a contribution. The limit is based on your income. And when you make the withdrawal from your RSP down the road, the withdrawal is taxable. We went over tax-free savings accounts, or TFSAs, which are tax-free investment accounts. So you do not get a tax deduction for contributing to this account, but it is tax-free when you withdraw, and any income inside the TFSA is also tax-free. And the limit is a set amount based on your age, and it increases by a fixed amount every year for the same amount for everybody. And then finally, we went quickly over what's called an open account, or a cash or investment account. There's a number of different names for this account. This account has no special tax treatment or limits. Any income earned in this account is taxable, and once again, there's no deductions. Withdrawals are not necessarily taxable, although there may be some tax implications. So those are just the three basic investment accounts we went over. We went quickly through fees and how fees on mutual funds are charged. Generally, they're a percentage of assets. They pay for the investment managers, which are the individuals who pick the individual investments themselves, the stocks, the bonds, etc. The advisor, which in this case would be us, and Asante as the dealer who oversees us. They pay for operating expenses of the fund, so marketing, legal, compliance, and taxes. These are quoted typically as an annual percentage, and they're based on a percentage of how much is invested. And then finally, we went a little bit into the different types of investment income and how do my investments grow. We went through capital gains, which are when an investment increases in value. These are the lowest tax form of investment income. We quickly touched on dividends, which is where a company will share some of its profits with everyone who owns a share or a stock in their company. And then interest is what is paid, just like you pay interest in your mortgage, interest is paid to you when you loan money through a bond or a GIC. So essentially you are loaning money to an institution, and when you buy a bond or GIC, and they pay you interest in return. So that was just a quick recap of our last session, just so that everyone knows kind of the basics we went over before. Now, getting into today's material. So on the agenda today, we'll go over some key concepts that will be helpful when we're discussing investment strategies. We'll go through the pillars of what makes a successful investment strategy. We'll evaluate a few different investments and go through the process we use to evaluate investments. We'll look at a few different investment management styles, and then we'll give you a cautionary tale in investing, which will just go over some of the common bias that occur in investing. Okay, Derek, why don't you kick us off with asset allocation?
There we go. Thanks, Christian. Great recap. And we're going to look at key concepts, the first one being asset allocation. That really simply means what portion of your portfolio or your investments are in different types of assets. And as we talked about last time, there's really only two basic types of investments. You own something, which is considered equity, or another term for stocks, because you have equity in your home if you paid cash for it, or the portion that is not mortgage. That's your equity in your home. And then we have where we've loaned money to somebody else, or income type of investments. So the basic asset allocation we break down is between stocks and bonds, or equities and fixed income. So in this sample here, we've just shown where fixed income is the larger share. Because we're in Canada, we've got a little bit of a home bias, Canadian equities or stocks, a little bit in US and international stocks. You could further break this down even more into small companies, large companies. There's so many different ways you could break it down. And for simplicity's sake, this is how we're doing it here. Okay, Christian.
All right, thanks, Derek. So Derek, why don't you just go quickly through the different kinds of investments and how they're named? Because a lot of times we'll see different mutual funds or investments with a variety of different names, and let's just go into a bit about explaining what those names generally mean.
Excellent, excellent point. There is a lot of industry jargon, and oftentimes you'll hear multiple different descriptions of the same investment. So somebody might call themselves a very conservative investor, as is shown on our screen here. That would be somebody that we typically classify as having only 20% or less in stocks or equities. So mostly in income-bearing investments, which are considered lower risk and lower return. A conservative investor now moves up a little bit more. They might also be called a balanced income, because they're moving a little bit more from the income side of things to trying to balance out growth with income. So they would typically have between 20 and 40% in their portfolio of stocks. And we move up to what most investors will classify themselves as moderate or balanced, which is anywhere from 40 to 60% in stocks. So a 50-50 portfolio would actually be a real good definition of a balanced portfolio, because it is equally balanced, 50% in the more conservative income-bearing investments and 50% in the more growth-oriented investments of stocks. Then as you move forward, some people would call it aggressive or balanced growth, because they're tilting the balance toward the growth side of it. So they'd have 60 to 80% of their portfolio in stocks. And then as you move into people we would consider very aggressive, they'll have 80 to 100% of their investments in stocks. And again, there's many different reasons why people will choose these things. If, for example, you have a great pension and the investments are intended for long term, they're just sort of for extra things or maybe even to pass on to the next generation, you really have no need for them. So you could be in a 100% stock portfolio, even though you might classify yourself as a conservative investor, because you're really not looking at using that money for a long time. So I think Christian mentioned it at the beginning, but if you do have any questions along the way, please just put them into the chat box at the bottom and we will be answering questions at the end. Okay, Christian.
Thanks, Derek. And I just really want to emphasize one of Derek's points when we talked about what is a balanced investment. So you can see just by Derek's explanation here that balance can mean anything from 20 to 80% in growth assets or stocks. So a lot of time when investors call themselves a balanced investor, there is really a wide range of investments that could be considered balanced. So it's important to distinguish if you're looking at a balanced investment, is it a balanced income? Is it balanced growth? Or is it truly balanced in that 40 to 60% range? So there's a number of different ways that a balanced investment can be allocated. So the next concept we'll go through is diversification. So this is a word that you'll see quite a bit when it comes to investing. And all it really means is investing in a variety of different countries, industries, sectors, and asset classes. Or quite simply, just not having all of your eggs in one basket. That's really what it comes down to. Diversification is really important because it spreads your risk out and basically reduces the amount of risk in your investments while actually increasing the expected return, because as some investments go up, others will go down. So the key thing is really we don't necessarily want all of our investments going up and down at the same time, because that generally means we're not diversified. A great example of where this helps is generally we would expect that stocks or equities would outperform fixed income and bonds over the long term. However, there are actually periods of history where bonds have done better over a number of years. So being diversified helps us earn a better return overall, because when stocks are down, bonds typically or fixed income typically aren't. So over the long term, being exposed to a number of different investment types will help make sure that our return is a little smoother and generally over the long term a bit better. Derek, anything to add on diversification?
It's an excellent point. It's just that actually some studies show that if you have any more than 80% in stocks, there's really no significant benefit over a 10-year term or longer time period, because stocks do drop from time to time. And if you have that 20% that's in bonds or cash, and you can use that to rebalance if you're sticking with your asset allocation of 80% stocks and 20% bonds, when the stocks drop, you have some cash or bonds, some safe investments that you can rebalance, reallocate, so that you're now buying stocks at a low point. And we all know that everybody wants to buy low and sell high, and that's the easiest way to do it. And as Christian said, it does speed up your recovery and allows you to actually end up with a better return over the long haul.
Okay. So Derek, why don't you take us through the idea or the concept of risk in investing?
Okay, this is can be simple and complex. Risk versus uncertainty. What's the difference? Well, risk typically talks about the ride. So if you think about a roller coaster, we're very certain what's going to happen. We know that we're going to have some really exciting times. Now on the investing side, the exciting time is when things are really going up. On the roller coaster, that's the boring side of it. And on the roller coaster, the exciting part of it is when you're really going down. For us in investing, we really don't like it when our investments go down, but we still know the outcome. Even if we're doing a loop-to-loop, we know that we're going to get off where we started, because that's how the ride works. So it's really just knowing that going into it, and again, with the different types of assets, stocks, we know that we're going to have a much wilder ride than buying GICs or bonds. So as we get into uncertainty, uncertainty is not knowing the outcome or something unknown. So if you got on a roller coaster that didn't have an end point, or you couldn't see the end point, you're wondering, is this going to stop at the end, or am I just going to fly off the tracks and that's the end of me? So there's really no way of trying to figure out what would happen in the unknown, in the uncertainty. So one of the most common questions is, well, what happens if the market goes to zero? Well, quote, the market is literally all of the companies, all the businesses in Canada or Ontario or wherever that market is. And that's really hard to comprehend, because if the market really went to zero, that means every business that we know of, every restaurant, every grocery store would be out of business. So how would we be functioning? The only way I could see that happening is if we turned into a communist country or something where the government took over everything and all of our investments become worthless. So it's really something that we can't know how to react to. And having a broadly diversified portfolio, the proper plan set in place, guards us against most of the risks versus the total unknowns that there's no way that we could know about. Christian, you want to add anything?
No, that's great, Derek. And like you said, the idea of the market going to zero is something that would just be so unprecedented that really, if we're in a world where the markets have gone to zero, generally speaking, and we often joke about this, that your investments will probably be the last of your concerns at that point, because even if they did have any value, you'd likely wouldn't be able to use them, because we would be in a movie at that point.
Mm-hmm.
So the next concept we'll quickly go over is what's an index. So this is something, a term that you'll hear quite often in investing is the index, or actually the market. So an index is actually just used to represent a specific market. So indices represent the performance of a specific area, sector, or industry. So there's a number of different indices. There's actually hundreds, if not thousands. But generally speaking, there's a few bigger ones that you'll hear a lot when you're watching the news. So the S&P 500, for instance, is the top 500 US stocks. The S&P TSX is the top 250 Canadian stocks. The Dow Jones Industrial Average, or the Dow, as it's normally called, is the top 30 US stocks. The NASDAQ is the NASDAQ Composite Index, and it represents about 1,500 stocks that are listed on that specific stock exchange. They are US and international companies. So these are some of the most common indices, and they're just used to represent the general health of the markets. So it's a great way for a quick look at, how's the US stock market or the US economy doing. Let's take a look at the S&P 500 index. Some of the Dow, for instance, only represents the top 30 US stocks. So sometimes if someone makes a comparison saying, the US economy isn't doing great, just look at the Dow. Well, now that it's only the top 30 US stocks, it's not necessarily a great representation of the US market in general. So there's a number of different indices that will be used to compare, but they're quite simply just an easy thing to compare performance of different areas or different industries. Derek, anything to add on indexes or indices?
That's a great point you make, because, for example, if you don't own any of the top 30 US stocks in your portfolio and the Dow had a great day, you might have actually had a down day, because every day in the market, I don't believe there's ever been a single day, I could be corrected, I'm not a historian, but I don't think there's ever been a day where all stocks have been up or all stocks have been down. Some companies go up and some go down. At the end of the day, what they do is they take the weighted average of all those companies and say, oh, the market was up. Now, that doesn't mean your stocks or your portfolio was up, but it means that the overall average, if you owned every one of those, was up that particular day. So it's important, again, to think about what's going on in the particular index that we're talking about. Because again, Canada is way different than the US, which is way different than Japan, and way different than Germany. So you might hear that, oh, the German market went up today. Well, if you don't have any investments in Germany, it may not have any impact on you at all. And conversely, in some cases, when some markets go up, it's because they're exporting more and so on. If we're on the importing end of that, our markets might go down because it's affecting our economy negatively. So again, a lot of different things in play there, but it gives you a general sense of the direction of what's going on with investments. All right.
All right, thanks, Derek. So now we're just going to go into some of the pillars of a successful investment strategy. So to start, an investment strategy is built on a few different things. The first is your goals. So what are you trying to accomplish? We like to use the analogy of a map. So it's hard to get direction if we don't know where we're going first. So when we're looking at an investment strategy, we need to know where we're trying to end up or what our goals are before we can figure out what we need to do to get there. So successful investment strategies always start with goals. The next is your current situation. So where are we today? Just like we used with the map example, if we know where we're going, but we don't know where we are, it's hard to get directions. So we have to start with key information like how much are our assets? So what are our liabilities or our debt? What is our income, our expenses? That's a good representation of what's our current situation when we're looking at investment strategy. And then finally, we like to look at risk. So a risk profile is built for you to represent how much risk are you comfortable with emotionally. So going back to what risk is the ride. So what kind of ride are you comfortable with? What kind of risk do we need to take in order to reach our goals based on where we are today? And then how much risk can we afford to take? So Derek meant, and that idea of how much risk can we afford to take may be a little bit harder to grasp. What that essentially means is going back to one of Derek's earlier examples, if we have a portion of money that is for future generations and we never plan on touching, we may not need to take a lot of risk in order to achieve our goals. However, we may be comfortable taking a little more risk. And since we're not using those funds or we'll never need those funds, we have the capacity to take a lot more risk. So we could say, okay, I'm going to take this money and I'm going to invest it in 100% stocks because I don't need it. I know I don't need to take that much risk, but I can afford to do it. So those are just the examples of kind of what goes into an investment strategy. Derek, do you have anything to add on that?
Yeah, just on the risk profile, and this is a question we often get asked is, well, I want to make as much money as I can without taking much risk. And so one of the aspects that we look at is to meet your financial needs, that's where we have to have the goals and know your current situation, is how much money do you need to make? So for example, if you won the lottery and you got $50 million and you only need $50,000 a year in gross income from it, we could put it into a 1% GIC and we're achieving your goal. You need to take no risk per se on the investment going down because you're earning enough money in something that's a very low risk investment from that perspective. So if you've only got, $50,000 and you're trying to generate $50,000 a year of income, you would be required to take much higher risk because you're trying to literally double your money every year. So that's what we talk about when we're looking at people. And again, every situation is different. Some people have pensions, others don't. Some people have no debt, other people do. So it's all those things taken together. That's why we need all of those things together to be able to recommend a proper investment strategy for you.
Thanks, Derek. So now, Derek, we're going to move into this section on evaluating investments. So why don't you walk everyone through how we evaluate an investment or an investment program?
All righty. So we take a look and first, we believe in diversification. I am not an excellent stock picker. I don't spend a lot of time researching individual stocks and don't think that I can outperform professionals that do that full-time. My expertise is in helping people clarify their goals, figure out where they are and what rate of return they need to get there, and then help them build a portfolio. So we look first for broad diversification. And again, that's, as we mentioned earlier, across different industry types, across different asset types, across different geographies. Now there's an which will remain unnamed for compliance purposes, but there's a stock trading app that as its disclaimer, when you first go on it, it pops up and it says, when you open an account, it says trading individual stocks is very risky and you should invest the bulk of your money in a well-diversified portfolio. So there is even a business that makes its entire business by having people pick individual stocks, and the disclaimer that they're putting up there is that this could be very risky to your health. So again, diversification is very important. And when we're investing outside of our RSPs or TFSAs, we also take a look at, are there tax efficiencies? As we mentioned in our previous webinar, capital gains are much more tax efficient than earning the same amount of dividends, which are even more tax efficient than earning the same amount of interest. So there are some companies or some investment types that are more likely to produce capital gains or defer capital gains, some that are more likely to produce income. So we look at that as a method as well. And fees are important. We look for reasonable fees. We know there is no such thing as a free lunch. And we've had, because we do most of our business on a fee-based, people see the advisory fee, which is Asante and our component. They don't necessarily see the underlying fees of the fund all the time. But I've had people come in and said, oh, well, the bank said they do this for nothing. And so I'll pull up the fund fact, which is a regulatory document, and I'll show them the fund that the bank is talking about. And lo and behold, their fees, their combined advisory fees and management fees were actually higher than our combined fees that we have here. Just you never saw them because they were buried. So we look for companies that charge a reasonable fee, but what do we get for it? Just like you don't expect the same kind of ambiance when you go and order a coffee at Tim Hortons as when you go to, Chateau Laurier or, the Royal York in Toronto. You're paying for more than just a cup of coffee. You're paying for other things. So same thing with investments. What are we paying for? Is that a reasonable fee? And what do we get in expectation for that fee? And we have to make sure that it's based on sound principles. So by that, I mean that they have some sort of strategy, some kind of theoretical justification, which makes sense on paper. One example, which again I learned early on in my career, is that small companies have a lot more room to grow. So theoretically, small companies should provide us with greater growth. So that's a good theory, but is it backed by actual proof? So we take a look at some justification. And one example that I've used, and again, this is not a historical one, but I use Coca-Cola, which has roughly 33% of the market share for soft drinks in the world, and Cott Beverages, I think they're still in business, but it had like about 3% of the soft drink industry. So if Coca-Cola lost 1% of market share, they go down to 32%, they go, oh hum, we'll pay out our dividend and we'll carry on, nothing is big deal. But if Cott Beverages lost 1% of market share, they go from 3% to 2%. And all of a sudden, people are getting pink slips, they're laying people off, they're cutting back on everything that they can. On the other hand, if Coca-Cola gets a 1% increase and goes from 33% to 34%, they go, oh hum, well, maybe we'll pay an extra nickel on the dividend this quarter, but it's no big deal. Whereas if Cott Beverages gets a 1% increase and they go from 3% to 4%, they're now having everybody work overtime, they're hiring more people, they're giving up big bonuses because they just had a huge increase. And so that's how it works. So let's now take a look, is there any historical evidence to back those principles? I'll let you walk us through the actual examples, Christian.
All right, thanks, Derek. So this is just a quick example of how these sound principles we talked about work in reality. So we're going to just quickly look at the idea of small companies outperforming large companies, like Derek mentioned. So for our comparison, we're going to look at the S&P 500, which is the top 500 U.S. stocks. So these would be the largest 500 U.S. stocks, versus the dimensional U.S. small cap index. So this is representing small companies in the U.S. So when we look all the way back to 1926, if you were to invest $1 in the top 500 US companies, and you would hold that, not touch it until the end of 2019, we would have about $9,200. So overall, $1 to $9,200, not a bad deal. However, if we look at what if we invested that same dollar into small US companies? So we would end up slightly ahead. But when you take a look at the scale of this graph and realize how much farther ahead we would really be, we're actually at about $32,000 for the same dollar invested way back in 1926. So this is a great example of how there's historical evidence to support the idea that small companies generally grow more than large companies over a long period of time. This is based on almost 100 years of data. And you can see just by looking at it, there is a little bit more, the ride's a little bit bumpier. You can see some of the higher highs and lower lows throughout that almost 100-year period. When we think about small companies having more room to grow than large companies, that's our theory. And then the evidence is supported right here by showing that, yeah, you know, if we invested $1 in small companies, we would have actually significantly more than we would if that same dollar was put into large companies. So before we go any further, we want to really emphasize something. It's important to consider past returns as part of an investment strategy. However, past returns are not a primary factor of evaluating an investment. So we were talking about the theory and evidence behind it. So that past returns may fall into evidence, but it's not a primary factor. So you may be wondering, well, how could that be? Isn't returns one of the most important things when we're looking at investments? Well, evaluating an investment based on just the past returns is a lot like driving while looking in the rearview mirror. It doesn't make a whole lot of sense, and it's probably going to lead to a number of accidents. So the idea that it's important to consider past returns as part of is there evidence to support what I'm doing? We also have to make sure that, you know, it has to make sense to continue doing what you're doing, and driving while looking in the rearview mirror doesn't necessarily make sense. So that's just to really hit that point home, that past returns are important. However, they don't necessarily predict future returns, and they need to be considered with a number of other factors, including does the theory behind why the returns were better in the past actually make sense? Derek, anything to add on that?
Great. As we move into common strategies or different investment styles, I'll use two examples. One you may have noticed in those previous slides, and Christian had mentioned it, that sometimes the small caps experience much higher highs, but also much higher lows. And more importantly than that is that if you notice in the graph, and it's quite a small graph, so you don't necessarily see it, but in some cases, the small caps underperformed for like 5, 8, 10, 12 years before they turned around and then outperformed. So again, it's not always the greatest thing, because everybody said, oh, I'd sooner take the 32,000 than the 9,000. Let's invest all in small caps. But they may not have a 15 or 20 or 30-year time horizon, which sometimes it takes that long for that outperformance to show itself. And so we have to be careful with that. The other one leads into the next the different investment strategies. So the first one is commonly known as active management. And so Peter Lynch, who managed the Fidelity Magellan Fund for about 15 years through the 80s, he was an active manager, which simply meant that he tried to pick certain stocks and certain sectors in an attempt to, quote, beat the market. So to beat the Dow Jones, the Dow 30 or the S&P 500, that was sort of his area of doing that. And he did a marvelous job. He outperformed the market over a 15-year period and had an average return, I think if you held it for that whole 15 years, for something in excess of 20% per year average over 15 years. Now you would think that that's a wonderful thing. However, Fidelity back in those days in the US was primarily a do-it-yourself fund. It wasn't sold through advisors. People just purchased it as they wanted to. And we'll get into this a little bit, but this is sort of the driving in the rearview mirror, is that at the beginning of each year, newspapers used to do this, if you can remember what newspapers were back in those days. The first couple weeks of January, they would list all the best and worst performers in the mutual fund industry. So a lot of these do-it-yourselfers would say, oh, Fidelity Magellan Fund did really well last year. Let's buy that. And then the next year, they would have a bad year. And they'd say, oh, somebody else is better. And they would jump in and out. Statistically, over 60% of the people that invested in the Fidelity Magellan Fund over that 15-year period, which had exceptional returns, actually lost money in it. Now, it's hard to believe that you could lose money on a fund that averaged 20% a year for 15 years, but that's because it didn't make 20% each and every year. Some years it went up, other years it went down, and people were simply looking in the rearview mirror, and when it was bad, they jumped out because they said, oh, it looks like it's going bad, and it was going well. They jumped in and said, oh, so they did the opposite of the buy low, sell high. They bought high and sold low. So, but active managers and Peter Lynch, and there are some people that have done this for sometimes 1 year, sometimes 2 years, sometimes 5 years. So it's, they will typically have a market that they're trying, or an index that they're trying to beat. So if it's a US fund, they would be looking at trying to beat the S&P 500 or something like that. That's their benchmark. So if you think of the classic stockbroker, and we don't see that so much anymore, but down in the pits, they're saying, buy this, sell that, buy, sell, because they're attempting to pick what they felt are going to be next year's winners or tomorrow's winners and get out of the ones that they think aren't going to do well. And some people can do that on occasion for a period of time, but it's very hard to do that consistently. So the main advantage, or the main advantages of this, is portfolios are built by teams of experts to get us the best return. They look at diversifying, they take advantage of current opportunities, they do have the opportunity to outperform and do it at different time periods. Now, there are some drawbacks. Expertise comes at a cost. Again, using the restaurant example, if you go to a fancy restaurant where they've got more waiters than they do patrons versus a self-serve buffet with no wait staff, you're going to pay more money even if the quality of the food is the same. So it's going to cost a bit more. Active management can also cause underperformance because sometimes those managers make a mistake and they don't pick the ones that are going up, they somehow pick one that goes down. And usually, not always, but usually they're much more concentrated. What that means is the S&P 500 has 500 stocks, as the name implies. Most US stock funds may only have 50 or 60 or 100 stocks. So depending which stocks they have, that can add to or be a drawback. All right, so Christian, anything you want to add on that before you take us to the next style?
No, that was a great overview of active management. Once again, it's a very hands-on approach. It's actively trying to navigate markets, pick winners, avoid losers, and it generally does cost more. Moving on to another strategy, which is called factor-based. So there's a number of different names for a factor-based strategy. They're also known as smart beta. It's another industry jargon that's used to describe this strategy. But really all it comes down to is buying a portion of an index or a market based on some criteria that have historically led to better returns versus the market. So this would be like our small cap example we gave earlier. Looking at the S&P 500 versus the small cap stocks, you could buy the entire US market and say, well, I'm going to focus just on small companies based on this criteria. So I'm going to look at a specific number, and if that stock meets my criteria, I'm going to buy it. If it doesn't, I'm not going to buy it. And you can really think of it as a filter. So here's our little coffee filter. We put in the whole market, and only a specific portion of the market gets through that filter because we've set up a number of different criteria to filter out the companies that we don't want, so that we only get the basket that we do. So the advantages of this kind of strategy it's a little bit lower cost compared to active manager, because you don't necessarily have somebody evaluating every single company. So on a general sense, they'll look at, okay, what factor are we looking at? Are we looking at small companies? Are we looking at companies that are value companies, which are generally just lower cost stocks? So this does give us an opportunity to outperform, and it's like I just mentioned, it's slightly lower cost. However, the drawbacks are it is backward looking. So that means we're looking at things that have done well in the past. Once again, that's driving while looking in the rearview mirror. So we want to make sure that there is still some theory behind it. So we do have that theory and evidence at the same time. There's less human oversight, so they're not necessarily looking at every single company individually, whereas an active manager may actually go sit down with the CEO of a company and talk to them, or the management or the board of directors, and say, hey, what's going on with your company? What do you guys think is where the company is going? And they can really get a good sense of if that company is a good investment or not, or at least a better sense. Whereas in a factor-based strategy, we don't necessarily get that. And then the factors can underperform as well. So Derek already touched on this earlier with the small cap idea. So smaller stocks, while over the long term, that data we showed you said that they do better, there are periods of time where they might not necessarily outperform. So it's not necessarily a guarantee, because that G word is almost a dirty word in our industry. You can't guarantee anything. So the drawbacks are whenever you take some sort of active approach, or in this case, you deviate from the market itself, you have a chance to do better than it, but you also have a chance to do worse than it. So it can lead to a slight underperformance in some cases. Derek, anything to add on factor-based strategies?
No, I think that's excellent. What it does is it tilts the factors that typically outperform in our favor. You're still investing very broadly, so you've got very broad diversification, much broader usually than the active managers. But as we've both pointed out already, that those factors can underperform sometimes for a significant period of time, which means will you stick to your guns for long enough to see the outperformance? Because sometimes we're not known for having great patience as investors. And then that leads us to the final sort of strategy that we talk about, which is called passive investing. And there's been a number of different ways of talking about this. I've seen, I don't remember his name right now, but he called it the couch potato investing. And really what it is by passive, it really means that. We're not looking to hire a manager. We're simply, hey, indexes seem to do well over time. Like, the example that Christian showed, if you would have just bought the S&P 500 in 1926, you would have done really well. No choices. You didn't buy or sell, and you just were part of the market. And so there are many investments, mutual funds, ETFs, that copy an index exactly. So they are just the S&P 500, or they're just the Dow 30, or whatever. So there's some great benefits to this in the sense that it's low cost, because there's literally no human oversight. You've got exposure to the broad markets. Again, depending, because they've now got so many indexes, as Christian mentioned earlier. In some cases, there's almost as many indexes as there are stocks. You can probably make up an index for companies that produce toilet paper and ship them to China. And that could be an index. It's a very narrow index, but that's something. But typically, most index funds are related to broader markets, such as the S&P 500, the TSX in Toronto, or the German market, or the Nikkei in Japan. So those you got broad exposure, and typically markets have done well over the long haul. It does have some drawbacks, and because there is no human oversight, you have no idea really what you're getting into unless you actually look at the entire indexes, and it cannot outperform. In fact, you're guaranteed to underperform a little bit, because all index funds do still have a management fee for putting it together, although it's very low compared to active managers. But definitely there are no fees involved in setting up an index, but if you're trying to match that, you do have to pay some fees. The other thing is that if they're truly an index fund, they have to match the index. So there's a little bit of a lag time. When a new company gets listed, companies are forced to buy that same percentage weight in their index fund, or if a company gets delisted, they're forced to sell. Typically, that means they're paying a little bit more because everybody's forced to buy at the same time. And when they sell, they're forced to sell perhaps at a little lower price because now everybody's selling at the same time. So that's sort of, we move from active, which is, again, a much more concentrated human oversight type of strategy, to a very laid back couch potato type of variety. So if we use the food industry again, active investing is going to the keg, and passive investing is ordering from DoorDash from a buffet that just says, here's option one. I guess I use a Chinese, I'm having number 5, please. And it brings you exactly what's in there. You have no choice. So, Christian, other thoughts?
Well, that's a great example. Passive investing is passive. They're not actively trying to navigate the markets. With all of these strategies, there's not necessarily a right or wrong strategy. Once again, we can never guarantee anything. So there's no guarantee in any case that an active strategy will do better than a passive strategy, or a factor-based will do better than an active strategy. There's really no guarantee what's going to outperform or what's going to do better in the future. So it's a matter of, how do you feel about your investments, or how would you want your investment managers to treat your portfolio? Are you wanting investment managers that are going to be actively, trying to navigate markets, picking good companies, avoiding bad, even if that comes with the risk that they may make the wrong call, or there is something unexpected may happen and they couldn't predict, or that they didn't predict? Or would you prefer something on the passive end that says, you know what, I know the markets over the long term are going to go up. I'm going to keep my fee. I don't want to pay super high fees. So I'm going to go on the passive side, and I'm just going to invest in the whole stock market. So it really comes down to, what is your preference? How do you want your portfolio managed? Neither are necessarily good or bad. They all have their advantages and drawbacks, but that's what it really comes down to when we look at which strategy to choose. So now we move into one of our later sections of the presentation, where we're going to look at some of the cautionary tales when it comes to investing. So this is going to talk about how as humans, we're wired to be bad investors. So many of the instincts that our ancestors developed over time to survive are actually counterproductive when it comes to investing. There's an entire field known as behavioral finance that looks to study these different biases, and we're going to look at a few of the most common and most dangerous ones. So the first one is known as outcome bias. So what this essentially means is you've evaluated a decision based on the outcome versus quality of the decision. So what that really comes down to, or a great example to illustrate what this looks like, is a roulette wheel. If I walk into a casino and I put all my money on 32 red, and it hits 32 red and I make a ton of money, was that still a good decision? I may think it was because, well, hey, I won. I doubled my money, or I made a ton of money from roulette. But there's a reason in reality that the house always wins. So the quality of that decision may not have been very good. However, it did actually pay off. So that's the idea of outcome bias. We're evaluating our decision based on what happened versus was it actually a good decision or a well thought out decision. When investing, Derek, I think you have a good example of outcome bias when it comes to investing.
Yeah, this example was a client whose husband was very actively involved in his own stock picking portfolio. We managed the registered portion of the portfolio, and he had an online account with stocks. Unfortunately, he wasn't always that good at it, and then he died. His wife had no idea of what he had in his portfolio, so when we're sitting and talking with her, she was looking at it. Portfolio was actually in a loss situation, and she said, I don't want to sell because I'll have a loss. And so I said, well, okay, I can't give you advice on stocks because I'm not licensed for that, but let me put it to you this way. of all those companies listed in there, if you had won the lottery or received an inheritance and you were going to invest today, and that's your choices, which ones of those would you invest in? He said, none of them. I said, well, then to me, that answers your question. Why would you continue to hold them if you wouldn't buy them? If you think they're going to recover, then put some more money in because you'll make twice as much. But if you're that unsure, if you wouldn't buy them today, then why would you continue to hold them? So again, her decision was based on thinking that it's going to recover. She's basing on what she's hoping the outcome to be, not necessarily on logic or good thinking. And that it sort of comes in, we've already talked a little bit about the next one, which is hindsight bias. And so that example with Fidelity Magellan Fund, where people were looking at the prior year's returns and making their decision. And we see it all the time that everybody wants to buy low and sell high. But if you look at cash flow going into stock-based investments and coming out of stock-based investments, when markets are doing well, we see more money going into stocks. When stock markets go down, we see people pulling money out. So literally, even though everybody knows intellectually they want to buy low and sell high, their gut, they're so uncomfortable when things are going down that they actually do the opposite. And that's why looking at last year's results or looking at past returns, we have to be very careful that, okay, what happened last year? How likely is that to repeat again this year? And that can lead into market timing. So, so many people believe that they can, that we should have been able to tell when, 2007, 2008, you should have been able to predict that. Everybody could see that coming. Everybody could see it coming after the fact, but not too many people saw it before the fact. So that leads us into market timing. We'll let Christian talk about that because he's much younger and smarter than me, and he could probably time the market.
I appreciate your confidence, Derek. However, me myself, I'm not going to attempt to time the market because just looking at some of the data in the past and when investors try to time the market, let's just take a look at what happens. So this piece of information came from JP Morgan. They're a large asset investment firm in the US, and they looked at the average return for the last 20 years based on a variety of different investments. So on the high end, they look at real estate or REITs. They looked at gold, the S&P 500, which is US stocks, a couple of different what we would call balanced portfolios, bonds, oils, the EFI, which is international stocks, homes, inflation. And then way at the bottom here, we can see the average investor. So the average investor during that 20-year period of time earned 1.9% a year, compared to if they would have just bought bonds. So just a standard bond portfolio, nothing in stocks, they would have earned 5%. So you can see that this data shows that the average investor wasn't even able to perform bonds, never mind a balanced portfolio that has some stocks or bonds, because they were trying to get in and out at good times and bad times. So that behavioral bias prevents us from buying high or buying low and selling high. And that market timing you can really see here how it can hurt you over the long term. So if you would have just bought and hold that portfolio, you have say 60% stocks, you can see the light blue bar, 60% stocks, 40% bonds, we're looking at 5.6%. That's significantly more than the average investor. And a lot of that is all attributed to trying to time the markets. So now you might be thinking, okay, well, that's just an average. There has to be some people, and Derek mentioned Peter Lynch and the Fidelity Magellan Fund. Some people must be able to do it correctly, and we'd be right. Peter Lynch was a great example. But the thing with Peter Lynch is he was one of the only examples. And when you're trying to time a market, even a slight miscalculation, a day late, a day early, can have pretty drastic results. So if we were to look at $1,000 invested in US stocks in 1970, so we put it into the US stock market, so the S&P 500. If we just bought that $1,000 in 1970 and held it, we would have $121,000 but at the end of at the beginning of 2020. Now, if we were to try to time the market and we missed just the single best day, we would only have $108,000. It's almost it's a $12,000 difference just missing one single day. If we miss the best 5 days, well, we're down over $44,000. We're at $77,000 here. You can see in that third bar. If we miss the best 15, we're down at $43,000. And if we miss the best 25 days, that's not a lot of time when you look at almost about 50 years of data. We're at $27,000. So you can see the idea of trying to time the market can really, really hurt you over the long run, just if you make one or two missed calls. Because if you say you get out at the right time, when do you get back in? And typically when markets go down, they typically have best days immediately following, the trough or the low point. But when is that low point? How would we know? This year, it was March 23rd. But you only know that looking backwards. And this gets back into when we were talking about hindsight bias. It may be easy to think now, it's like, oh, if I could have just gotten out on March 20, before March and gotten back in on the 23rd, and I would have made tons of money. But how would you have known? Nobody would be able to say back on March 23rd that was the low point. We didn't know. And if we would have just mistimed that by even a couple of days, you can see it can have quite a significant effect on how much you're left with over the long run. Derek, anything to add on that?
Yeah, I'll just I can give a very practical example from my early days in career. Thankfully, I learned a lesson. There was this U.S. manager that had outperformed the S&P 500 for 12 years in a row. Unfortunately, it wasn't available to Canadian investors. Then one of the Canadian mutual fund companies hired him to manage a fund just like that. So I started putting some of my clients a little bit of money in that because, hey, this guy's beat the S&P 500 12 years in a row. The next 12 years in a row, he underperformed the S&P 500 every year. And so while they still made money, they would have been better off just putting money into the S&P 500 index. So again, even somebody that can outperform for a period of time, much like any kind of sports team that wins a championship, it becomes harder and harder to repeat year after year after year. And so, sometimes it's just different people have a different strategy that is working at that particular point in time, but no strategy works forever. So again, timing the market is extremely elusive, especially on an ongoing basis. So I think that wraps us up. So if you do have any questions, please put them in the chat box below. There's a couple of them that we had sent in. So I'll answer the first one while you're adding any additional questions, and Christian and I will see them. Is volatility the only way to measure risk? Well, volatility, if you remember, that's the up and down, the ride that we're having, is actually a very poor way of measuring risk, but it is a way, and from a regulatory standpoint, that is how our investments are classified. And it simply means how much do they go up and down. So an example I like to give with clients, although this is a fictional example, you could have an investment that makes money every year, but some years it only makes 1%, and some years it makes 30 or 40%. How much it makes really goes up and down quite a bit. Therefore, that's a high risk or very volatile investment. You could have another investment that's very, very consistent. It loses somewhere between 1/4% and 0.5% every year, but it never loses more than 0.5%. It never loses less than 1/4%. So it loses money every year, but it would be considered a low risk investment because it doesn't bounce around very much. So actually, that's one measurement of risk. We look at other risk factors as well. Is your investment outpacing inflation? If you're only earning 1% and inflation is 2%, there's no risk to your capital, but there's a huge risk to your buying power. This happened back in, for those of us that are old enough to remember the 19% Canada savings bonds. People say that was wonderful, except the top tax bracket was 50% or over 50%. So you lost about 8 or 9% to taxes, and inflation was 12%. So if you'd put away enough money to buy a car at the beginning of the year, 1 year later, even though you'd earned 19%, after taxes and after the inflation going up on the price of the car, you wouldn't have been able to buy that same car a year later. So there's all sorts of other risks that we try and take into account on your behalf.
Mhm.
Christian, how about how much diversification do I need? You want to take a shot at that one?
Yeah, so when it comes to diversification, generally speaking, we like to be broadly diversified, but what does that really mean? From a regulatory standpoint, really it means we need to have at least 5 different investments. Anything less than 5 means you have more than 20% in one particular investment. In this case, we're say at one particular company, and that would represent a concentration risk. That just means you have a little too much in that one name or a couple names, that if those investments were to go down, it would have a really significant impact on your portfolio. Generally speaking, 5 is kind of the regulatory standard. However, from our perspective, we like to be broadly diversified. When we use mutual funds, typically they're no more concentrated than about 50 names, but they could have as much as 10,000 names. So when it comes to diversification, the regulatory compliance's view on it is about 5 investments, so no more than 20% of your portfolio is one specific investment. However, we could hold just one mutual fund that holds 50 to 10,000 different investments underneath. So it's a little bit of a mixed bag, but generally speaking, we're looking at least 50 companies when we're holding any mutual fund, and that, as when it comes to our philosophy on investing, that's the kind of diversification we're looking for. Derek, anything to add on diversification?
No, that's a great thing. And again, the reason for diversification and the compliance risk, if you have 5 individual stocks, for example, and one stock goes bankrupt, which is quite possible, then you've lost a significant amount of your investments, and it may be hard to recover from that. And again, those rules are in place to protect you. And it's one of the reasons we use mutual funds, because even though we might have only one mutual fund, we have way more than 5 individual investments within that, and we're not in that same kind of concentration risk. We're running a little over what we had planned, so unless you type in another question, there's one more here that I'll answer, and then we'll close off for this session.
We did get one that just added that I think would be a great one to touch on,
okay.
Actually. So there's the question is, there's been talk that there's a possibility that the Bank of Canada will have a negative interest rate to try and get the economy moving. What does that mean for people who have money in the bank? Derek, do you want to start? I have some points on that, but why don't you start on this one?
All right. So it doesn't, in one sense, doesn't directly affect our bank accounts, other than the fact that the Bank of Canada is the rate at which it lends money to other financial institutions. And typically what we borrow from our banks or what they pay us for putting money on deposit in the bank is related to that. So I don't think that if you've got a GIC, we're going to see a negative GIC rate. The Bank of Canada is going to lend money at a negative interest rate, which really means that when banks put money on deposit with the Bank of Canada is actually going to charge them. So what they're trying to do is get the banks to lend that money out or to invest it to stimulate the economy. So they will offer lower interest rates on loans for you and I to buy a house, to buy a car, to do whatever, to try to stimulate spending. Our interest rates on our GICs and daily interest bank accounts will also be very low. So people will then have a tendency to want to, hey, well, I'm not earning anything, I may as well go out for dinner or buy a car or do something with it because it's not earning anything. Or I need to invest in stocks, which oftentimes will help stimulate the stock markets and provide growth in that manner. Your points, Christian.
Yeah, Derek, I think you touched on a lot of great points when it comes to that. Just from a business perspective, if a bank were to make a savings account or a bank account with a negative interest rate or offer negative GICs, who's going to buy those? So that's the one thing we can be almost certain, and I use that word very cautiously, But a bank would never charge a negative interest rate for a checking or a savings account or a negative GIC, because quite simply is, if I'm going to lose money by putting it in the bank, well, I'm just going to keep it under my mattress at home. So when it comes to that, it just generally means, like Derek said, it's the interbank lending rate. So if I go and deposit money into RBC, and RBC gets a lot of deposits in one specific day, and TD gets a lot of withdrawals, well, to balance out their balance sheets, they borrow and lend to the Bank of Canada. So the Bank of Canada essentially acts as the main lender. So any banks that received a lot of deposits one day can then lend money to the Bank of Canada, who will then turn around and give it to banks that received a lot of withdrawals in one day. So this is just to make sure all of the major banks in Canada, that they have a balanced balance sheet, their deposits and withdrawals. So that's what that rate talks about when we look at the Bank of Canada rate, is just how much are they charging for interbank or interinstitutional lending. It has nothing necessarily to do with your bank accounts. However, like Derek said, it does indirectly impact how much they charge for mortgage rates or loans, and how much you're going to earn on your savings, just because it's going to affect their bottom line. So when it comes to your checking account or GICs, we won't see a huge difference. It may just mean that checking accounts right now, or even I would say savings accounts, are only earning about 0.1%. So that may go down a little bit. However, it's not going to go negative in your bank account, because quite simply that wouldn't make sense from a business perspective, and everybody would be trying to pull their money out if the banks went to a negative rate for bank accounts or GICs.
Great additional points. Do you have any other questions that came in, Christian?
There are a couple, but in the interest of time, we'll have to save those for another time. That's just because we're running a little bit late. So with respect for your time, we want to thank you very much for attending our session today. We will be hosting another webinar on year-end tax planning in the future. So keep an eye out on your inbox for the invitation, which should be coming in about 2 to 3 weeks. And we look forward to seeing you there.
All righty. Have yourself a great day. Thanks for joining.